Hey everyone, Dave Keller here with StockCharts.com. It is such a pleasure to be with you on this special series at the end of 2022, looking back at the last 12 months. It has been an eventful year, and I remember being on a market outlook panel the first week in January of 2022. And it is very difficult to look forward, 11 to 12 months and be projecting where things may be and thinking about where things may head. But what's funny about it are these charts that I'm sharing with you. A number of them I kind of was looking at the end of 2021, because as you felt this market projecting to the upside at the end of last year, you certainly felt the possibility of the market moving lower. And if I remember right, I feel like I mentioned we're going to have a 10 to 20% sell-off before we rally probably into year end. And I don't know how well I would grade that overall assessment. Again, try to project 12 months of market behavior is kind of a ridiculous ask anyways. But I definitely saw the signs of potential weakness. And a big part of that was the Fed clearly changing from what I would consider a bullish positioning to a bearish positioning, or to put it more clearly, an accommodative stance to a more restrictive stance, right? 2021 was a liquidity-driven bull market by the Fed injecting liquidity in the system. 2022 has been a liquidity-driven bear market, right? With the Fed reducing their balance sheet, withdrawing liquidity from the system. And as a result, the market has been certainly struggling. And, arguably it's, I don't think arguably, I think it's clearly been the right move for the Fed to take more restrictive stances with things, but it certainly caused us to have an eventful year with some interesting leadership themes, which we'll probably be addressing in some of the other 5 charts of 2022. But the first one I want to share with you today is the chart that you see on my screen, which is the S&P 500 using Fibonacci retracements. I really wanted to have at least one of these 5 charts really focused on the S&P, because that is the most important chart, in my opinion. That comes from years of working with money managers, many of which were benchmarked to the S&P 500 or benchmarked to something close enough that understanding where we were at relative to the S&P was key. So out of all the macro charts that we would do on top of our regular exercise of picking stocks, the S&P was the main thing we would look at. And so, when you look at the chart of the S&P 500 over the last 3 years, which is what we're basically doing. So I went back to February of 2020 so that we could capture the March 2020 low. And then we see the January 2022 high, and then we have the Fibonacci retracements between them. So a couple thoughts on what this chart is and why it's so important. Then we'll talk about what I think it represents and how I think it could be important going forward. So when you have a market that has had a significant run, and then you start to see signs of a change to that pattern, meaning a stock or an ETF has been in a big accumulation phase, and then you see signs of a rotation lower, or the market has been in a big downtrend phase and you see signs of accumulation, you see a rotation to the upside. Fibonacci retracements are designed for that particular use case, which is basically once you've set the framework from low to high or from high to low, and you start trading within those extremes, the Fibonacci retracements are designed to help you identify key levels. For me, a big part of my process is identifying and really anticipating support and resistance levels, right? Identifying meaning looking to the left on the chart, starting at the final bar, looking to the left to see what levels are meaningful, but also using something like Fibonacci retracements to anticipate support or resistance. I would argue something like trend lines are a similar methodology, right? Different toolkit, but drawing a trend line to identify or anticipate where future support and resistance levels may be, it can be a really important part of the toolkit. And then seeing how the market reacts or plays around those levels can be very, I think, insightful, very informative. So really what happened with the S&P from 2020, the low in March, to 2022, the high here, a move from S&P 2200 to S&P 4800. What a significant rally, right? From the COVID low, which again, at this point, the market's in free fall and we're not sure whether the economy will survive, or we're not even sure we'll be able to see each other in person ever again, to where we're at now, or where we're at in January of this year, where the market is in a raging bullish phase. So as we rolled over, and again, what's funny about this chart, it immediately looks like a head and shoulders pattern. It's not ideal because you've got some choppiness, but a high in January the lower high here in September of last year, the lower highs here in February, March of this year, you take the swing lows and sort of that distribution pattern, those lower highs in the first quarter into the second quarter really confirm the fact that we were no longer in a bullish phase, right? If you're bullish at this point and still expecting a buy on the dips and we move higher, that failure to eclipse the February high when we retested it in late March, I think was one of the key signals of 2022. So at some point, hopefully you recognized the distribution phase. And then the question is, what levels are important? Now, the first Fibonacci levels that I used in 2022, thinking back to the first quarter, were these ones in green. It might be a little hard to see because I've got a couple different ones on here, but if you took the September 2020 low to the January 2022 high, we can see 4,200, 4,000 or a little above there, and then 3,820, we'll call it 3,800, are the three key levels. Now, why did I take that September low? So the whole way that you apply Fibonacci retracements is first you have to determine which are the most important levels to watch. So as the market's at 4,800 and coming off of it to like 4,400, throwing around a downside objective like 3,800 seemed absolutely ridiculous, right? Because it's so far away. Now, we got there, right? And but that doesn't help you navigate this 6-month period, just saying, all right, hold on, at some point we'll get 3,800. So you have to use different timeframes. And so for me, the September low was an important one, arguably, other than the March 2020 low, that was the most important one, because during this uptrend phase, there were very few meaningful pullbacks, particularly in 2021. The deepest pullback, I think, was 5%, probably here in September. Other than that, it was like 3 to 5% was pretty much it. This correction, this sort of consolidation pattern in the third to fourth quarter of 2020 was the longest in terms of time duration. It took about 3 months once we reached that pattern and established the pattern to finally resolve out of the pattern to the upside in November of 2020, right? So we had this sort of consolidation, a coil pattern of lower highs, higher lows. You call it a coil pattern or symmetrical triangle pattern. That pattern resolved to the upside. We broke above this congestion area, broke out there. So the pattern resolved to the upside. That suggests much further upside. So that consolidation to me was a meaningful thing, arguably besides the March 2020 low, the most meaningful point in 2020. So I thought that was a good starting point to the low, the Fibonacci analysis. The high there in January, obviously the peak. And from there, we look at levels. So 4,200 was this first level down. That's pretty much the first leg down in January, bounced off of there. We had further tests of that same level in February and March and finally broke above it. When we broke down through that level, we eventually sold off to, that's right, the 61.8% levels around 3,820. And that was one of the main reasons why we highlighted that as such a key level. So if you look at it, the two key points in the first 6 months of the year, I would argue really we're playing around those first two Fibonacci levels. But once we broke down through 4,200 and retested the highs in March, March into April, and then failed to eclipse them and made new lows, then you have to bring in deeper retracement levels, because then you have to recognize the fact that, okay, this could be a much longer, deeper downtrend, right? We may need to really think about downside potential, in which case, what are the key levels that we want to pay attention to? So from there, I started to look at a broader Fibonacci analysis, and the most obvious levels here, looking at the last couple of years, are the COVID low in March 2020, and then the January 2022 high, the peak, the all-time high for the S&P, just above 4,800. So when you set that framework and you look at the three Fibonacci levels, and I consider the 38.2% the most important, 50% is really a secondary level when you're looking at Fibonacci retracements, but it's commonly used by a lot of different toolkits, even outside of Fibonacci analysis, like Gann, WD Gann was very big on the 50% level as a key point. And then you have the 61.8% level down here. When you apply those, you have the 38.2% sort of jumbled up here, but it's around 38.15. So round down around 3,800. That's about a 20%, 21% drop from all-time highs. The 50% level, just above 3,500, represents about a 27% drop off of all-time highs. And then the 3,200 level, which represents a 61.8% retracement, gets us down to 3,200. Now, I've talked about that being my downside objective for the S&P 500. It still is my downside objective for the S&P 500. I think that's where we eventually bottom out in the first half of 2023 as a foreshadowing for what may be coming next. But that's why this level, that's why this chart, I think, is so important to continue to watch. But getting back to these levels, look at how the different Fibonacci frameworks kind of line up, right? So on the shorter term, when I took the September 2020 low to the January 2022 high, 4,200 and then 3820 were the two key Fibonacci levels. 61.8% is 3820. That's almost identical to the 3815 we get if we use the March 2020 to January 2022 low. So 38.2% of this longer distance is right about at 61.8% of this shorter distance. So that's why that was such a key level. That's why the May low made a ton of sense. That's why if you think about the June drop as a gap below that level, but then a failure to follow through, I think that's important. And then we finally broke down through that here in September. 3,500 is a 50% retracement of the overall move. For now, that appears to be the low for 2022. Again, barring some magical, crazy sell-off in the last 2 weeks of trading during the holiday season, which would be, needless to say, highly unlikely, if not almost impossible. So that pretty much the low is in for the year, the October low, right around 3,500. If and when we break 3,500, which I think we will, then that initiates the 3,200 level. That is important from a number of different frameworks. Obviously, it's the 61.8% retracement of the way all the way down. It also retraces 100% of the way back to the September low. So that really important consolidation level that I talked about how significant that was, round tripping back to that level to S&P 3,200 would make a ton of sense using this as the overall framework of your analysis for the S&P 500. So that's why these levels were important. And again, I think the test is how well did this help you make sense of the market? This is a chart I refer to often during the course of 2022. We reviewed it very often on this show, and I know I shared it a number of times with my premium members at Market Misbehavior because it was such a great way of thinking about the the potential. And it's tough when the market is at 4,800 and starts rolling over to think about extreme downside objectives. But once the trend is down, you have to look at the possibility, not the probability, but the possibility that you get to extreme downside objectives. And I think using this chart really helped me to think about it. So what does this mean going forward? Well, as we go into the new year, I think this pink shaded area, which is just above 3,800, that comprises these Fibonacci retracement levels from these different frameworks. I think that's an important level, right? As we go into the new year, December is a seasonally strong month. November is a seasonally strong month, and November obviously was pretty good for stocks. December actually tends to be a strong month as well. You have the Santa Claus rally, a lot of year-end window dressing and tax trading that happens. As a result, the market's usually at the very least flat, at best up a little bit or up significantly, but usually up a little bit. January is seasonally the weakest month of the year. And so as we have some strength here, November and December, we're setting up for what usually is a painful year because all of the stuff that happens at the end of the year to make things look nice, all of a sudden deteriorates very quickly once the holidays are over. And I think in 2023, once investors recognize the reality of what the Fed is planning to do through the course of next year, and also thinking about what that will do to growth stocks most likely, and also how much our benchmarks are geared towards growth. If rates go higher, which we'll talk about in a future episode probably this week, if rates do go higher, highly unlikely that our growth-oriented benchmarks are going to thrive in that environment. So I think this one is key. Watching if we do a rollover in January, which I think is probably likely, that 3,800 level will be important. If we break that, you immediately think about 3,500 as at the very least an important pause, right? An important downside objective. I think 3,200 is the eventual low. If you think about what the Fed is looking to do in terms of their plan to raise rates, to continue to address inflation, how long it most likely takes for inflation to get down to normal levels as defined by the Fed and their objective there. You think about what sort of uncertainty is going to be baked into stock prices, how earnings in the first quarter and maybe the second quarter reflect the pressures and the challenges that sustained high inflation rates are causing for consumers and for their businesses and their ability to grow earnings. I think highly likely that 3,200 becomes a downside objective. What I would say, though, is if and when we do get to 3,200, talk about, I would say on paper, what most likely appears to be one of those great buying opportunities, potential buying opportunities, right? If you think about the market giving back 34% of the way from March 2020 to January 2022, and giving all of that back, and the companies and the potential you're able to buy in at a discount of 34%, off of where it was at the high. I think that's a huge opportunity. It's so funny. I often thought of bear markets as very negative, frustrating times, but spending time at Fidelity with long-term investors, they would get all excited because the portfolio managers would say, look, I get the opportunity to buy great companies at a deep discount. This is fantastic. So I think we could be setting up for that. I don't think necessarily that the bottom is in for this cycle, and I think 3,200 may be the level to watch. But this particular chart, looking at Fibonacci retracements, one of the great charts of 2022. That's why it's my first of the top 5 charts of 2022, and one that I will certainly be following going into the new year. It's been a pleasure to be with you this year on the Final Bar. Look for the next 4 of the top 5 charts of 2022 through the course of this coming week, and have a fantastic holiday season. We'll see you all next year on the Final Bar. For StockCharts.com, I'm Dave Keller. Be well, be safe. We'll see you again soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.